Good morning, good evening, wherever you are. This is another episode of the Two Tokens podcast with our own Jonny Fry hosting it. Welcome, Jonny.
Oh, I've got to say something, have I?
You do.
Oh, thanks very much.
Talking with the microphone, mate. You know how it works.
Absolutely. Oh, that's what it is. Okay. All right. Well, thank you for tuning in and welcome to Two Tokens Masterclass. Here we are towards the end of yet another year, December 26. I think this is our fourth Masterclass we've done in the beautiful city.
Sixth. This is the sixth.
Sixth one.
We have 220 alumni.
Time flies. Yeah. 220. Good stuff. So the whole idea behind this, for those of you unaware, it was really Two Tokens was established and partly EU funded to help people understand how tokenization works from a regulatory and a legal and a practical point of view. We're going to park to one side anything about crypto, because what we're more interested in, how does the mechanism of tokenization, how does it impact business? How does it impact your customers? And today, delighted to be joined by Tony from a company called TPX. And we've got a particular focus here on the tokenization of real estate. So welcome, Tony. Perhaps you could give us a bit of background to yourself and a bit of information on the company.
All right. Jonny, Alex, hello. Good to be here. Thank you. Love to be back. Actually, it's been a couple of years since I popped in to see you guys, so this is a pleasure to be invited again. Now, for your audience, what TPX, and I'm the CEO of TPX Property Exchanges, to give my full title, Antony Abell, CEO of the TPX Property Exchanges Group. We have some 11 companies now that we're working on across a global deployment of our TPX Property Exchanges and what we're doing within them. And so I'm going to take everyone down a little journey here, explaining what it is that we're up to. It applies to all of us because all of us have a house generally, or we live in a house, or we work in an office, or we work in a building. And what TPX has been up to with the UK government is very carefully, very diligently, we think, structuring a system by which people can IPO their homes on a public regulated exchange.
Or you want to solve the asset-rich, cash-poor problem.
This is a big solution for us. Mm-hmm. So we're looking at this on a multiple of different layers. Not only for the homeowner, we're looking to IPO their house and, yes, get some equity out of it. But it's not the traditional product, an equity release or a remortgage product, because intrinsically, they end up costing almost more over time.
So is it more along the lines of equity or along the lines of bonds?
Well, see, this is the journey that we're going to go on right now. Oh. So what TPX has done is working with the FCA, the Land Registry, the Bank of England, Treasuries, and other political parties, aspects of government, the political agendas that they have, is we very carefully construct a system by which you take the title of real estate, not a REIT, not an SPV, not a share of a company that owns a property, but the title itself of the property, recognized by our land registry, recognized by our governments, recognized by our courts. And we're turning that into effectively a micro title. And that micro title now can be used directly in payments and settlements on global payment systems. So your Visa card, your MasterCard, it replaces it. And now you're buying your coffee at Starbucks with a slice of a property. That's never been done before. Now, our technologies allow us to get rid of that terrible illiquid problem of property. We now make it a liquid tradable instrument with atomic settlement and speeds that are 10x of current MasterCard, Visa card technologies. And doing that, turning property into money itself, changes the dynamics of our economy at a time when our economics, too much debt, too much fiat currency, too much inflation, are somewhat strained. And this, we think, on a long run, on a big picture, is a return to what we call the asset-based economy, or in economics terms, sound money, inflation-resistant money. Now, I think everybody on this, listening to this podcast, would like to be paid in inflation-resistant money. It sure beats the hell out of some of the stuff that our governments are issuing us. And this is what's very, very interesting for us. So those who are in the real estate industry, those who are looking into it, those who are part of real world assets of the markets, as they currently say it, as they transition away from our argument is, from a fiat debt-based system into an asset-based system, an asset-based economy, then it starts to get very interesting for all of us. And we envisage a world where people will increasingly choose to be paid in assets, not in fiat currency.
So maybe you have some questions, but two questions come to mind, because this has been the promise from day one when you and I were still in the Muppet Show. But the first question is, of course, what registries allow this?
Okay. So in our early years, we sat down with the land registry, HM land registry in the United Kingdom. And we looked at all the primary legislation, secondary legislation, case law, legal opinions. Lawyers love to be paid for these things. And the end result is we made a very strong case with them, and they agreed that the title certificates that we created by our exchange mechanism, trust, transparency, AML, KYC, all the requirements that you want in a responsible system, having baked all that in, they agreed with us that the titles that we're creating were indivisible under law from title of a larger property. So title is title is title, whether it's very small or very large. Now, the land registry in the United Kingdom only takes 4 records. So we had to work with them, and using the Beneficial Act of 1925, it allows us to create a beneficial trust structure where the recognition of the ownership of the asset is always confirmed via that structure and visible and transparent to the land registry. Simple matter is this one, is the land registry gets what they want. In the UK, they're a little, shall we say, constrained on their budgets at the moment. And so now the land registry is able to get a better land registry more cheaply through us for the properties that are on our exchange than they can generate themselves. So they've been wanting to go down this path for a long time. It's just they didn't have the economic case to pay for it, and they couldn't find enough corporate interest out there to pay for it for them, for us.
In the UK, you didn't have to change the civil code
No.
to do this.
Yes, no, we're well aware of the difference between English common law and Napoleonic code here.
Yes. Yeah.
And so we do see a path by which we're deploying this across Europe.
That would be my second question.
I
How
thought
can
we
we
covered
do
it
it?
too. I knew you were going to let me off the hook that easy.
So Tony, you've thrown in a bit of history, and I'm delighted you've come today, because every time I come to Holland, I have to remind actually a lot of the attendees how progressive the Dutch have been. And a lot of the Dutch think that they're backwards when it comes to sort of financial markets and fintech, that they want clearer regulation, they want things to put them at the forefront. The reality is the Dutch have led globally for centuries. They were the first to invent joint stock companies, as we know them now, sort of, limited liability companies, Indeed. Stock exchanges, bulbs, even gin, mutual funds in 1794. But it was actually the British, with the National Land Bank in the 1690s, when there was a battle going on, wasn't there? And you actually had 2 entities that were established, private companies. One was the Bank of England, which remained private until, I think, 1946.
Correct, after the Second World War.
Which was essentially funded because the Brits had been roaming around, particularly Europe, and scrapping, and they'd run out of cash. They were borrowing money off the goldsmiths, and that was all that hullabaloo. But at the same time, the Bank of England was set up. The National Land Bank was set up. So on the statute books in England, we actually have the ability to settle transactions using property.
Well, here's the fun piece. You're absolutely right, Jonny, so thank you for that one. 1696, Land Bank was set up, and it gained the statutory powers by which its title certificates that was created and the form of script that they were using was recognized as legal tender by the UK government. Those statutory powers still sit on the books.
So nothing's really, what you're saying here, it's not new, but we've now got the technology through distributed ledgers, i.e. blockchain technology, to do this crazy thing called tokenisation. I create a digital representation. So rather than moving bits of paper around, we can move around in a digital format.
And indeed, you're absolutely right. There's nothing new here under the sun. And for those who like to have a quick cast at history, the term coining was invented by the British around about 1670 or so. And they were coining property, literally. So this is not new. Second, we had then the assignés in the French. The French seized the lands of the nobility and the churches, and they turned that into a form of script, which then became their money, and they used it to buy their bread, et cetera, et cetera. And upon pain of death, did you try to use anything else? So after they worked out that no one, well, everyone needed money, and there was economic warfare at the time, and the British forged a lot of this and delayed Napoleon a little bit.
So we're back in history. It's economic warfare again.
Well, we even had the old Dutchman, didn't we?
Yeah.
King William, he was on the throne at one stage.
Yeah.
We're sort of
He triggered a lot of that. Yeah.
Well, it always comes down to money, guns, and steel. So
Yes.
it's sort of that sort of aspects of things. So this is not new. And arguably in history, wars are caused for the bankers. Now, take your own view on that. But certainly what we've identified now in our current economic cycle What we're doing is not new. As always, we want to have a good idea, look to history. And history has frequently gone down the path of looking at real estate as a form of script, as a form of money. That didn't always work out well. Forgers, not very appropriate systems, information was slow. What has changed is, of course, we have the blockchain now. And the blockchain creates a single version of truth in terms of what's that asset, where and when, who owns it, precisely down to the microsecond. These things are very important when you're dealing with, obviously, atomic settlements, very fast systems, traders who want to obviously do their arbitrage. All of this is a key ingredient to move property from what is an illiquid asset now to a globally liquid asset. And in some of the presentations I'm giving to Two Tokens today, we'll be looking very briefly at how over the last 50 years, the price of gold and the price of properties relative to people's salary has remained almost the same for an average house. So over the last 50 years in the United Kingdom, the price of a house was about 152 to 180 at top. 155 is where it netted out, ounces of gold for a house. So the gold price has gone up. What is changing, however, is the amount of labor that it takes to buy a house. So now it takes a lot of labor to buy a house. AI, robotics is coming in. This is all changing the formula. And part of our premise, part of our investment thesis here as an organization is that we're moving to an asset-based economy where assets replace money in the common form that we're looking at it.
You were talking about that, weren't you, Jonny?
Yeah, well, this has been coming for a while. But Tony, I'm interested to go back to you identified at the top of the podcast someone old like Alex and I, and we're sort of asset rich and income poor, so we could sell. Alex lives in a hovel in Rotterdam, I think it is. Sorry, not hovel, a beautiful penthouse.
It's a hovel, no.
And let's say it's €1 million. So Alex could sell 10% of his house and actually have €100,000 to spend. But flip it on its head, and my son and your son, with respect, it's tough to buy a property, whether it's London, Paris, New York, Singapore. Property prices in sort of key cities like that are very, very expensive. People to go on the register.
Not just it's spreading out all over Europe. You go to Spain, same thing, right? So,
and particularly to your point, because their incomes haven't kept up with the pace of property. But with what you're doing, you could also allow someone on lower income that hasn't got much equity to actually own maybe sort of 60% of the house, and 40% would be owned by someone else, a bit like sort of co-ownership. And of that 60, they can still get a mortgage. So actually your son or my son or our daughters could actually have maybe a small deposit. They could have maybe, a 30, 40% mortgage, and the balance is owned by someone. So it enables them to get onto the property ladder.
Indeed. Here's a dirty little secret of the banking industry. We like dirty little secrets as they get revealed. Fundamentally, the banking industry has not liked too much light to be shown on this. But when we signed that mortgage document and signed it across the table to the bank manager, there's a good reason why the bank manager was smiling. Typically, they were making somewhere between 8 and 24 times the face value of that mortgage within 3 days of you signing it. And the horrible thing is we were paying for the privilege of them being able to do that.
Yeah.
It's not a very equitable system, I would argue. And what TPX is pioneering is based on part of our sharing economy concept, is that we think that is rather iniquitous. We think the banks will always have their distribution. We're producing the product that they want, tier 1 AAA rated asset that they can put on their balance sheets, which are already approved by central banks and the BIS and others as an asset which they recognize on the balance sheets of banks. We're giving the banks exactly what they want, but we're forcing them to pay the title owner this time for it. Now that's new. Our technologies didn't allow us to do that before. Now they do. So
take me through that journey. Suppose I would want to, sell 10% of my property.
Yes, of your cave.
Of my cave,
okay.
I come to you. What do I do?
Taking the glorious hovel in Rotterdam.
Yes. Yeah.
Yes. So what happens is you IPO effectively your property on a public recognized exchange, authorized, approved. Systems, transparency, trust, working with regulators.
But are you going to come by and check that it is indeed my hovel?
Indeed. Okay. We actually pull the real estate industry in with us.
Okay.
Because we're giving them the opportunity, from our point of view and the models that we've done, to earn more money than they've ever earned before. Because not only just now are they buying or selling, but they can part sell a home. And that's well within, because they're selling title. They're not selling a financial instrument according to our regulators. That allows them to do business as usual, but only part selling the houses. So this becomes very attractive for them. They're selling clean title. They're not selling a financial instrument. There's no yield or generation. They're allowing people to IPO, in your case, your house in Rotterdam. You're allowing it to IPO on a public regulated exchange with the real estate agents, with the regulators. And that allows you to do full search and survey, because everyone wants to know what they're buying. Think of it as a due diligence room in the private equity world. You get to see all the details. That's recorded onto a template, a structure that we use on a blockchain, which gives you permanence and transparency. The property owner is still in control of the process until such time as a price is agreed in the primary listing structure. So it goes to 2 tiers of listing effectively.
So, and then the IPO happens and Jonny says, oh, I like to have that 10%. What is this return? Why would he do that?
Yeah. Well, for every property owner, we believe on all the modeling we've done to date, it's about a 3 to 8% uplift on the property. Right now, a lot of people are suffering with negative equity in their homes. The prices are down in a lot of urban centers. People are looking for liquidity, or at least partial liquidity. So fundamentally, they can list with us on our numbers model. We're expecting them to make 3 to 8% uplift on each property, like for like, compared to the neighbor's house, so to speak. The people who are working with us, the private equity firms, the family offices, are working with us in what we call our primary listing event. A deal goes on there. The valuation is agreed there, but the market is deciding, not necessarily a surveyor, which is great for the surveyors because their insurance is reduced.
Yeah.
They just need to produce the information, confirm it's correct, and then it goes into the deal room for pricing. Typically, 15% of what is due to be sold goes into that, because there has to be enough to create a market. A price is agreed, and then it goes on to the secondary event. The secondary event is where the pop happens. So we're expecting that 3 to 8% happen at that point. We expect the first price to be roughly what most people, both sides, would expect in terms of market pricing. It takes a 3 to 8% uplift when it hits the secondary. And at that point, the family offices that we're working with, and those PE firms that we're working with, they typically would look to exit. And so they've done the underwriting. It goes into the secondary. They take their 3 to 8% up, their portion off the table, and then they do it again. Now, for the family offices that we're working with, the lovely thing about this is their only exposure in the entire process is to liquid title of real estate. So their risk exposure is very well within typically the parameters of a wealth office or family office. So this works very well for what they're trying to do. And on that model, we're expecting those family offices to make 68% annually on that real estate listing process, the IPO process.
But Alex, I'm asking you a question. Why would someone want to diversify? Most people have got 70, 80, 90% of their wealth tied up in the home they live in.
No, I know why I would want to sell it, but why would you want to have 10% in my, and what would be your
pure diversification? I believe longer term in real estate is a good hedge. I don't want all of my money in UK residential property, in my property. So therefore, if I could actually release some money out of my house, then to have diversification, whether it's in the UK or whether it's in a
but it's also more than that. It's also sound money, because if you look at, I mentioned the gold aspects and gold over time, how it parallel tracks with the prices in terms of relative to labor. So it ends up as a, from our point of view, from our analysis, it ends up as a potential new gold standard for the world, because it's only in real estate do you truly have enough out there in the marketplace to match the M1, M2 money supply of the world. You can't do this with gold. Gold's too clunky. We always love the argument you can't live in a gold brick. So it's fundamental intrinsic value for real estate is much better. There's always more of us. There's never enough properties, et cetera, et cetera. So there's always a very healthy demand curve for property. And we're always behind the curve in terms of supply. So it has a very nice profile in terms of a long-term appreciating asset. A long-term appreciating asset is a very stable form of money, if but only you can make it move fast enough around the world. So we're looking at 10 millisecond end-to-end transfer of asset in terms of those speeds. That's atomic speeds. And that allows us to meet what the institutions are looking for in terms of liquidity. We also have other aspects of our building technology, derivative chains, other things to make sure it goes faster, insurances, to make sure that the people who are listing the liquid portion of their house, we call them the 49ers, have 24/7 subsector.
So
liquidity.
you've gone to market in the last 2 years, and are you aiming, to reach the retail investors, the consumers?
Inevitably.
Or I think there would be too much overhead and too small tickets.
You're correct.
To do this, right? So I'm sure you're working with commercial.
We're markets guys.
Yes.
So this is not a pure real estate play.
No.
This is a markets play, a liquidity play.
Yeah.
All right. Global liquidity brought to the local property to give the financial institutions and the central banks and the banks what they want. We're producing a very valuable, very stable intrinsic value asset, which we think what's already often declared as a reserve asset. So we give the nation states an opportunity to work with, shall we call it, an old reserve asset made new. Because hitherto they've never been able to move it at speed. It's always been illiquid. Now we make it 24/7 sub-second liquid, and all of a sudden it becomes, we believe, the most desirable asset for most people to hold on their balance sheets.
Well, it's the biggest use case for tokenization, right? That's what Larry Fink said.
I'm not sure about that. There's one bigger than that, which
Would be.
But the derivatives market.
Oh,
It's
right.
1.2 quadrillion. I keep
Yeah,
telling
yeah,
you this.
yeah.
But the property market's huge, isn't it?
Yeah, I mean, we're looking at
Savills, what, 380?
if you count it all in, it's about, with all include China, it's about 465 trillion.
Okay.
Okay, so
Fair size.
M1, M2 money supply is about last count about 128 trillion worldwide. So you got to have enough of that good stuff moving
But the
around.
residential, that was the figure I was supposed. The residential property market is about 75% of that.
About 75, yeah. It's a bigger portion
And
of it.
then agriculture about 10, and I think commercial was 15 from memory.
That's about right.
These are all Savills figures, not
Yeah,
numbers.
yeah, yeah.
Okay.
So for us, it's a very large marketplace. Our intention as exchange operators, we have an ecosystem approach. So it's not just about the TPX Property Exchanges. We're due to deploy the first 20 of those over the next 18 months now. London's going to be first. We do tend to follow English common law. We'll come back to your Napoleonic Code. In a moment. We do tend to follow English common law, but we also are working with a number of different organizations in Europe to see how we can apply Napoleonic Code to this. And there is some reasonable examples of how this is already working by associations, these sort of things, which allow the ownership of a title of something to be fractured across the ownership of theoretically many hundreds of thousands for a particular property rather than just a few.
Tony, you've recently done a press release. Can you just, because this is going to take a bit of cash to get going.
Yeah. So the good news for anybody listening is it's taken a little bit of doing, particularly UK, raising capital in this market. It's always been interesting. But we've just closed a $47 million funding round with a firm called Echo 8 Investments. And they're going to help us fund. They've taken an ecosystem approach to us because it's one thing to do linear engineering where you do something that was done before a little bit better. There's always a good business in that. This is an ecosystem approach. This is a new operating system for real estate on a global scale if we get this right. Our model is a Uber deployment, so it's a SaaS model. It deploys very quickly worldwide. We have launch teams already poised to start running these exchanges in the States, some in Canada, moving to Asia, Australia, and then we start to do the European exchanges and the Middle East exchanges. So it's 20 exchanges over the next 18 months is our target. These exchanges are rather profitable. So they're very attractive for our local launch teams to buy into them.
The family offices, are used to kickstart the IPO, and they take their return, and then the liquidity in the secondary market. How do you go about that?
Okay, good question. So delving a little bit into the technology, I don't want to bamboozle people here, but we have a four-chain ecosystem approach, BTC fork, open, permissionless, and it's designed for other people to use and build upon. And it's designed very much to enable the very, very fast movement of the asset. For those who are studying this space, a couple of things which are novel is we're sovereign and jurisprudential to the real estate that exists within its nation state.
Hang on. What is sovereign jurisprudential?
Am I using big words with
Can
you
we
again,
put it
Jonny?
into English and Canadian, please?
Okay. So sovereign means it operates the rules and laws that apply to the asset, real estate, in that jurisdiction continue to apply into the future, even though it's in a digital form. That's huge. You can't do this on an Ethereum chain. You can't do this on a Solana. You can't do this on a lot of the other chains because you have to have all your nodes in one city to do this, to be able to apply the law. And no nation state's truly going to allow its primary asset of the nation state to be deployed in something they can't control.
Exactly.
You can't allow the U.S. to tax every transaction here in Europe. Rest assured, they'd love to.
They're going to,
Yes.
somewhere or another.
Somewhere or
their
another.
way.
Yeah, and so you can't
Think
afford.
Trump will have his way.
And when we built all this, it's sovereign, it's jurisprudential, laws apply. The other aspect to it is it allows the courts to apply rescission to the chain. So I have this wonderful phrase for the institutions. No institution will ever buy into scale into your product until they can sue each other. And if they can't sue each other, you don't have a legal grade which they can allow themselves or their clients or their whoever else they may have behind them to invest in that asset class. So that's what we give them. I joke quite oftenly when we set all this up, because we've taken a long time to set up, worked with the FCA, Bank of England, Treasury, as I highlighted before. I went around to all of them and I asked them what they wanted for Christmas. And then I gave them that thing. Bank of England, be very open about it. They're terrified that the pensioners are going to run out of equity in their homes and are going to become dependent on the state when the state doesn't have enough money to look after them.
Reverse mortgage to do your pension.
Yeah. And don't even ask me about the true numbers that sit behind the UK indebtedness. That's a bit of a scary story. So doing nothing is no longer a solution, and they realize this. It's forcing the adoption of technology at speed because they know what happens if they don't. Treasury. We're offered them, and very publicly we've said this, we're offering them 36 billion of tax revenues in the next 5 years. If we get up to our scale that we're thinking about, we can offer them that every year. And simply put, the stamp duty that they're doing at the moment collects 11 to 12 billion. Because we're taking a micro stamp duty on every transaction worldwide for the movement of a title certificate of that nation
would that
state.
be under UK jurisdiction then? So the UK Treasury...
So
even if you sell something in another country,
we're going to have a bit of fun here, as I like to do on these things. Two men in a bar in Argentina.
Yeah.
Right. They decide to have some of the local beer. They take out some of the wallet technology that has our title certificates on it. They pay for that beer in perfectly acceptable title certificates, which is acceptable on the EMV, the Eurocard, Mastercard, Visa network. That transaction, when it goes through, everybody gets their taxes, right? And the land registry here, the HMRC here, UK, and the Treasury by default, they then get a micro stamp duty fee on that. And we've offered that to them. The end result is you can remove some of the headline pain of a stamp duty, because these are basis points. They're very small, but there are a lot of them. So a house, instead of in the UK selling every 9 years as it does, and they're getting their stamp duty on that, they might get that house sold theoretically 60 times a day. All right, and they'll get a lot more tax revenue from us than they ever got from their previous stamp duty.
Wow. Well, I didn't think we were going to have a beer on the house, did you?
No.
Tony, it's been fascinating. Thank you for coming and explaining. I know we've got a presentation later on to the Two Tokens Masterclass. And Alex, thanks for putting it all together. And you've been listening to another edition of the Two Tokens Masterclass podcast. Please check out on the Two Tokens website. Not only have we got a number of other podcasts, but we've also got Tutti Frutti. And before I go, can you just explain what Tutti Frutti is, Alex?
So, tutti tokens, is Italian, right? All the tokens. So we've been doing this since 2018 now, with all your lovely articles, the digital bites, all the white papers, all these podcasts. And a lot of that is still relevant. What we did 8 years ago is still relevant today. It's amazing. And rather than putting that all in white papers that nobody read, we put it in an LLM called Tutti. So you could ask any question, but also pertaining to this, in 6 languages and get answers. And we're feeding it with continuously. On tokenization, on the digital economy.
It's like a version of ChatGPT, it's sort of, or Grok.
But it's all contained within the Two Tokens ecosystem, though. Yeah. So.
Very good.
There you go.
I admire good technology.
Thank
Good
you.
to know.
Well, Tony, thanks for joining us, and thank you for listening, and thank you, Alex. Another wrap, as they say.
Another wrap.
That was it for today's podcast. Thank you for listening in, and please subscribe so you don't miss out on our upcoming episodes. If you want to get in touch with us, you can find our contact details at www.twotokens.org.